Liquidity is one, if not the most important concept in trading. It is what traders like me and you can use to understand the market's narrative and then position ourselves into buy or sell trades without becoming liquidity. However, most people still get it wrong. But the question is why? Because liquidity is not just equal highs and equal lows. It's more than just that. We need to be smarter. But before we begin with the video, go to my website, the link is in the description below, and enter your email address so that you can be made aware of any future updates in regards to the trading software or anything else. Okay, so let's get back into it. So the common misconceptions, or should I say the common practices, not really misconceptions, but practices that we see when it comes to liquidity is everyone looks for equal highs, so something like this, and then equal lows as well, which will be something like this. And then we have the good old, trendline liquidity going down. And then we got an example here of trendline liquidity going up. Another good example is probably kind of like a ranging market. So if I can find something around here where price is just going sideways, what would be a good example? Like this. Price going sideways this way, price going sideways, you can say this way as well, and then essentially waiting for that liquidity to be taken out. So we go back to here. Those are the examples that we have of common liquidity. But there's liquidity that I would say is known as invisible liquidity that not a lot of people know about, and it's because they don't have the right tools to access it. So what you want to do is you want to go to your indicators tab, click on that and type in FXN Asian session range. That's going to open up this over here, and then it should display like that. Now what this tool or indicator, should we call it, does is it essentially shows you where the sessions are active, and so where there's going to be more, let's say, people trading within the market and therefore more liquidity in the market. And so when you know where liquidity is going to be more active in the market, you know that those highs and lows are going to be where liquidity is going to be. So for example, if I just run through this area of price action over here, we have the Asian session, which is in blue for me. So this high here is going to have a lot of liquidity. Price is trending downwards, so this low shouldn't have too much liquidity below it, right? So there's more liquidity here, and there'll be some liquidity here as well, and as you can see, price takes it. Now let's look at the London session. Now obviously these, let's say, colors or patches on the indicator are good estimates, but if we have a high that's slightly out of it, you'd count that as a high, because remember, price action traders are going to look at price action and be like, okay, so if I'm entering short from here, I'm going to put my stop above the high. So for the London session, this would be where the liquidity will be, and that will be the low of the liquidity. Same thing for the New York session. If you're taking shorts from here, or traders are taking shorts from here, where's the stop's going to go? It's going to go here, right? Or even there. And then obviously the low's got liquidity as well. Now if you look at these highs and lows, you'll notice that they get taken. So New York low gets taken here, Asian session high gets taken over here, then you got the London high got taken with this move up as well. Okay, and if you just keep looking, you'll see it get taken. Like for example, this is a really interesting one, right? Because we have Asian low that doesn't get taken, so that's probably the start of the big move to the upside. We get London high gets taken by New York, and then New York's previous high gets taken by New York. And one thing to essentially mention is that these highs and lows will get taken eventually, and so these are good areas and targets for price to go for. Like for example, this area hasn't been taken yet, and so at some point in the coming week, I can expect that this will eventually get taken, because there's going to be a lot of liquidity hiding behind this low, hiding behind this low as well. But we can see from the price action that price is trending up. Now another good avenue to look for liquidity, which a lot of people don't use, is actually candles, and I'd go for the hourly candles and the 4 hourly candle. So these are the two candles I'll be looking at from an intraday perspective, and the reason is because when an hour closes, people expect stops to be below that hourly candle, and so, or above the hourly candle. It depends on essentially which direction people are taking trades in, and which direction people think the market will go in. But for example, this hourly candle here will have a lot of liquidity below it, and you can expect in some cases that liquidity will be present, and people will come and raid that liquidity. The market will come and raid that. Same thing here. So we had liquidity above here, and as you can see, it gets taken by this move up here. Obviously you got equal lows there as well, but again, the better entry would have been if you look for this to be taken, and then look, you get that sharp move down. And then we move to the 4-hour time frame, same thing, right? 4-hour candles are very important. We know that a lot of traders trade, wouldn't say intraday, but let's say swing trading, where they're trading for 3 days, and so their entries would be on the 4-hour and or the hourly time frames. And so 4-hour candles are very important, and that's why when you see like an hourly candle close or a 4-hourly candle close, you'll see a lot of initial momentum. Price moves a bit weird. It starts to get an injection of, you can say, trades, and that is active liquidity. And so that's something that to be very, very careful of as well. And finally, it's going to be the good old daily and weekly liquidity. So if you look at daily candles, you'll notice that liquidity above them will get taken. So if I just highlight this area here, so there was liquidity here from this move down, and then price goes and raids it. Now let's look at another example, and I'm just looking at this randomly, right? So you got daily candle, let's say here we had this push up, and then you have liquidity above it from short traders, and then you've got that grab of liquidity, and then price pushing down. You can also say, we have an order block there, so it gives you more confidence. But when price opens up here, we know there's liquidity above there because there's people going short, and that gets raided, and then price comes lower. But the same thing with the weekly, and the weekly is something that obviously ICT uses. Daily is something that ICT uses as well. Daily is something that I also use, looking at essentially marking out daily highs and daily lows and looking for raids for them. So for example, something like this, I would mark out the low, mark out the high, and then on this day I'll be looking at price pushing into, well, taking the high and looking for some sort of reversal. So I'll be marking this out like this, be like, okay, we're in an order block, we should get some sort of reversal. Once you get a pattern on, let's say, the 15-minute time frame, I'm hoping that there is something here, but there's probably bound to be some market structure shift, and then you can take a trade. So you got this, there we go, there into a fair value gap. You got one there, and then you got this here as well. That's probably something you can take it from. I'll probably take it from here, and you're looking at shorts from, let's say there, stops just above, and then you got your trade, but you're using the daily time frame to give you the idea of the trade, right? And as you can see, that it goes all the way down to fill this fair value gap there, and then price continues the way it wants to go. And again, that's just a daily time frame. We can use the weekly time frame as well, just the way ICT uses it, by marking out weekly highs and weekly lows and looking for price to essentially do what we did with that daily example and go and take that liquidity hidden above the highs and hidden above or below the lows. So that was just my really quick video about making sure you guys understand that liquidity isn't just highs and lows, or equal highs and equal lows. It's also things that are somewhat hidden. But if you have the right tools like the Asian session range, and if you're aware of hourly candles like the 1 hour candle, the 4 hour candle, and then the daily and weekly candles as well, and above those highs and lows of those candles, you'll be able to see there's liquidity there, and you can start to earmark, keep an eye on, and better understand why price is going in directions, why we get quick moves like this, and how to essentially avoid being liquidity and take advantage of what the market is showing us, and somewhat not showing us, and get into better trades. That's it for today's video. Thanks for watching. I'll see you next time.